You look at the first blush reaction in the markets, you have short end yields absolutely plunging. You have futures getting a bit of a bid. When you go through these numbers, is that the correct reaction?
I think it is, and I think this was the report that the market was looking for. You might have had a bigger reaction if it was a stronger than expected report, but this is the reaction of pricing out the last hike that the Fed suggested they might have to deliver. And so I think that market reaction makes a lot of sense. The front end of the curve, both in reals and nominals, is where you're seeing the biggest reaction, and that prices in the near-term expectations for Fed policy. So the labor markets are normalizing, and that's the main message from today's payroll report. Wages are softening a little bit on the margin, not really much movement in the 3-month averages. The 0.2, it just missed rounding up to 0.3. It's a 0.24. So you're seeing still the slowness in the last piece of the puzzle here, which is the slowdown in the wages. And so the Fed's going to still talk about that. But when you look at labor force participation, that's a big change. That's what the Fed wants to see. As Randy said, that's the reason for the increase in the unemployment rate. But as we saw earlier in the JOLTS data, this is exactly what the Fed is looking for in terms of getting the normalization in the labor market, seeing that reduction in the vacancies to unemployment coming through the vacancies, less from the pain in the unemployment. And that's a good outlook for the market. And that's why you see the equity and the risky side also positively responding here. So pretty much a very nice number for everyone to go into their last holiday weekend. Yes.